33. Oh, we're starting to record now. Excellent. Okay. So it's like when you go into Baskin Robbins and they have like 33 flavors. Advanced estate planning is the same way, right? Like we can have a million different trusts, and trusts can do very different things. And I think there's a lot of confusion about trusts, but we'll get to that in a second. So we're going to hop in then to the standard estate planning documents. And we actually do have 5 starting on the next slide. So we do know how to count. We do know how to be disciplined, right? So number 1 is the will, right? Like we really do need a will. And there's a lot of reasons we need a will. So, outlines how your assets are distributed after death, naming guardians, executors, right? They got to be current. They're governed by state law, not federal law. So that's important because when you relocate, you change states, that matters. If you have property in more than one state, then you need to address that, probably also in a revocable living trust, right? Because state law will differ on how your property is treated, and probate is, again, governed by state law. So like some little wrinkles there. Here's the bottom line rule here is if you have not updated your will recently, then you need to review it. Okay, fine. If I have to give you a date, I'm going to tell you right now, if your will is before 2017, that is a black line rule. You must update your will if it is around from before 2017. Okay, so you got to update it because the TCJA, Tax Cut and Jobs Act, was passed in December of 2017, and it changed a lot of the rules in connection with estate planning. And so if your will was drafted before then, it might have the wrong formulas in there, and that would be a problem for you. Okay, so that's sort of a bottom line rule. But having said that, if you're like, oh, Debbie, we updated our will in 2020, and I put my neighbor in there, but now I don't talk to my neighbor anymore, well, then you need to go update your will, okay? If you change states, you need to update your will, right? If there's a major family change, you need to update your will. So even if it's more recent than 2017, we need to use some common sense and not be lazy about this. All right, number 2, the revocable living trust. Hey, I just mentioned that. So we're seeing a lot about the revocable living trust. And let's talk about what it is not. Okay, the revocable living trust is not going to save you estate taxes. So at the bottom here, right, does not save estate taxes. Let me see, can I do this? Does this let me do this? Look at this. Jen, look at that. I am very tech savvy. Does not save estate taxes. So not all wills are tax saving documents. And there's a lot of wills, trusts. And there's a lot of confusion about that because people are like, oh, I don't like my daughter-in-law. Like, can I just draft a trust? Oh, I want to save taxes. Can I just draft a trust, right? Like, it's not that easy. And one of the things I also see is that there is a cottage industry of attorneys out there that there's a shortage of work for those attorneys because the lifetime exclusion is now $15 million per person. So they don't have a lot of work. And so now they're all out there with these seminars trying to push all this trust planning. And so be careful because it's not that I'm against trust. Okay, I have trust set up for my own children. So it's not that I'm anti-trust, right? Anti-trust, family like that. It's that I am anti-unnecessary trust. I'm anti-complexity where we don't need complexity. And the attorneys don't care about that because they get paid more money if they're drafting trusts, okay? And they're not around to administer the mess afterwards. That's you and that's us. And we deal with that a lot, and it's a big headache. So if we're going to do a trust, let's make sure we have a good objective that we're trying to solve for. And that's literally what I'll say is over the last 2 weeks, I've sat in front of people, prospects, and both of them were like, yeah, we want trust. Yeah, we need a trust. And I said, well, what's the objective here, right? Like, what are we trying to solve for? And they didn't really know. It's just like, oh, rich people have trust, or we think we need a trust, right? And so let's not throw trust at every single problem. Let's be intentional. Sometimes there are less restrictive ways to approach it. And if possible, then we want to leverage those less restrictive ways. Also, certain types of trust can drive up your tax burden because the trust tax rate schedule, courtesy of the Obama administration from many years ago, is a very aggressive tax rate schedule. And so what happens with estates and trusts is that you are taxed at the highest rate, which is 37%, if your income is $16,000 or over, right? $16,000 of income. That's not a lot of income. So if we just start willy-nilly putting assets into trust, when our income is over $16,000, which again, not hard to hit that number, now we're taxed at the highest rate. So we want to be sensitive to all of the consequences of these trusts, right? The compliance issues, the ongoing tax returns we have to file, the higher tax rates, and a number of things I will not bore you with. Having said that, the revocable living trust can make sense in a number of situations. So Jen, I'm going to put you on the spot. Tell me one or two reasons that a revocable living trust can make sense.
Well, one of the main reasons that people do it is to avoid probate for their kids, so they don't have to deal with that. A lot of people actually put their house in a revocable trust as well, so that that's an easier asset because there's no designated beneficiaries on those assets. Like with the IRAs, you can set those up and make your individual accounts TODs. So I would say those are a couple things that I would say is pretty common.
So those are great examples.
Mhm.
So what are some things then to think about? Is if you have property in multiple states, then you want to think about a revocable living trust because then you can avoid probate in those states, which is one of the things Jen referenced, is it helps you to avoid probate. And you don't want probate in Florida, New York, New Jersey, right? And some probate in states is harder than others. So it's not necessarily like, oh, I need to avoid probate all the time, right? Probate in New Jersey is not an issue, okay? Your surrogate is elected by a county. It's a county office. So it's elected. They're very accountable to the public. So probate in New Jersey is not an issue. But probate in New York, nightmare. Probate in Florida, nightmare. And you don't want to be probating in a multitude of states anyway, because that is just a huge headache at a time when you don't need it. So that's where a revocable living trust can make sense, right? If you have owned property in multiple states. The other place that it really makes sense is, let's say you have somebody who's single on their own. Yes, they have powers of attorney, but the brokerage houses, the custodians, the banks, they don't want to accept powers of attorney because it creates liability. So they think of any reason they can to reject powers of attorney, including, oh, this is out of date, which sometimes it's only 2 or 3 years old. Oh, this isn't our form, right? So now you have to have a power of attorney drafted by an attorney, and then you have to have the form of the custodian, right? So they really, really make it hard for you. If you have a revocable living trust, it is a much more powerful document, and it's going to be sort of much more evergreen and help you in those situations. So if you're single and you're like, hey, I got this property, I got these stock accounts, I want things to be seamless. If I become incapacitated, the power of attorney, yes, I have it, but I'm a little bit concerned. That's where the revocable living trust gives you a lot more protection. So those are two key areas for the revocable living trust. And remember, once you die, the revocable living trust is like no longer in effect. So, that's when you then start focusing on the will. Okay, good. Let's go to number 3. And remember, it does not save taxes, though. It doesn't save estate taxes, right? Okay, the irrevocable trust. Now, look, my pen mark is still here, Jen. How do we get rid of my pen mark? Are you able to do that? Here we go.
Oh, there
I
we
did
go.
it. I
You
did
did
it.
it. Yeah.
Okay. So the irrevocable living trust. So the irrevocable living trust, different than the revocable living trust, right? So that was the previous slide. It was revocable. That means you can change your mind. Okay. Irrevocable means the opposite, right? Means you can't change your mind. Now, of course, it can be drafted where there's some flexibility. So don't read too much into that. But the irrevocable living trust, right, is created during your life. And yeah, there are some restrictions about it. You can't just throw it out the window if you change your mind, right? So it's a little bit more of a serious undertaking. You're giving up the control of your assets. The trustee is now managing them, and you're essentially removing them from your estate, right? Removing them from your estate. And when you remove them from your estate, then you can reduce potentially your federal or state estate taxes. Unlike the revocable living trust, which we just talked about, which I told you does not reduce your taxes. Here, because you pushed it out of your estate, now then you're able to potentially reduce the size of your estate because you push this asset out, and then potentially reduce your state or federal estate taxes. Also, if drafted correctly, and it's the intent, can provide asset protection from creditors, lawsuits. So that is protection from creditors, and predators is what they call it. Creditors and predators. So creditors are like, hey, I'm a doctor, I'm worried about lawsuits, right? Predators are like, hey, that future daughter-in-law that I'm very concerned about, that future son-in-law, misspending or what have you. Now, there's all kinds of irrevocable trusts. So don't get me wrong here. There's a lot of flavors on this, and they can be a very effective tool in the estate planning. But again, they've got to be in the right hands. We've got to have the right objectives. And we want to be intentional about how we use these and not just be like randomly drafting trusts. Okay. But if you have an estate tax issue, which that means $15 million single, $30 million couple, then having an irrevocable trust or several irrevocable trusts can then push assets out of your estate, drive down the value of your estate, and then potentially save you federal or state estate taxes. Now, remember when I just talked about the 15 million or the 30 million? Those are the federal lifetime exemptions. If you are in one of the 18 jurisdictions that have an estate or inheritance tax, then that number is likely to be a lot lower than the 15 or 30 million dollars. So in New York, it's like $7 million. And there's 18 jurisdictions that have an inheritance or an estate tax. So you want to be sensitive to that as well for your clients. All right, number 4 is the living will. And this is really to help you with healthcare decisions, right? And so in New Jersey, you cannot have co people on your living will, right? It has to be a delegate or a designated person, and then a substitute, a second. So you cannot have co-designees, okay? And this is generally to family members with some outline of how you want to handle advanced healthcare directive. If there's no quality of life, no chance of you regaining quality of life, and again, and that's up to you and your attorney to draft these so that it makes sense for you, right? When you go into the hospital, they typically require that you have a living will. So you want to do something like this in advance anyway, and not like at the last minute when you're signing into the hospital for your surgery, right? Good. Let's go to the next one. Powers of attorney. Everybody should have powers of attorney. And there's really 2 types. There's the springing power of attorney, think springing, right? And then there's durable. Springing power of attorney means that you need to have a disability, typically certified by 2 doctors, and then the springing power of attorney will come into play, all right? The durable power of attorney means the second you sign it, Jen has complete control over the estate if I make Jen my agent. The second I sign it, okay? So I sign it, I'm fine, all right? I have all my capacity, but Jen now has all that power, so she could go out, tell me she's going to Starbucks, but really go to the bank and start emptying out all my bank accounts, okay? So that is something Jen could do. Now, I don't think Jen's going to do that, okay? I trust Jen. We've been around for a long time. And it is traceable. I mean, if Jen shows up and empties out my bank account, I'm going to know Jen did that. It's not so great, right? And so I feel like there's some bad results from Jen taking that action, but it is something you need to think about. Having said that, the springing power of attorney has its own issues because you have to have 2 doctors certify the incapacity, and that is a bit of a headache. And the whole idea behind the power of attorney is to give it to somebody that you trust, put it in a drawer, and then when you need it, you take it out of the drawer and you dust it off, and you're like, okay, I'm going to need your help here. I'm, incapacitated. I'm not able to make it to the banks. I need you to handle my business for me. This is getting very complicated. So I need you to really step up as my agent. And so in practice, that's typically what we see. And so I would generally prefer the durable power of attorney, but it's got to be somebody that you trust completely. If you're worried that they're going to take a Starbucks break, but really go to the bank and empty your account, then, you should not be giving them a durable power of attorney, or you could give them limited abilities under your power of attorney. So maybe if I'm concerned about Jen emptying out my bank accounts, I could say, Jen, I'm going to give you a limited power of attorney where you're able to walk my dog for me, and you're able to take care of my cat for me, but you're not able to empty out my bank account for me, okay? And so there are limitations that you could put on the power of attorney, if you so choose. But again, ideally, you find somebody that you trust, you have a conversation with them, you put it away until it's necessary. Okay, good. Those are 5 documents, Jen. See, we can count. Okay. And by the way, Jen, I don't think that you would go to the bank with my power of attorney. I don't think you would do that, right?
Yeah, I would never, Debbie. I'll take
Okay.
care of your dogs, though. I would love that.
You would? You like Philly, right?
Yes.
Yeah, yeah. Philly's awesome. Okay. So, what is the difference between a trust and a will, right? And this is interesting because I do think there's so much confusion on this, right? And so the will takes effect only after the death, okay, of the testator, right? The trust can be effect during your lifetime or after death because, like we said before, trust can be very flexible. There's a lot of ways you can draft these things. So the will, if you put something in the will like, oh, Jen can empty out my bank accounts now, and that's in your will, right? That's not going to matter, right? It's not going to matter. Although Jen could try to point to that and be like, oh, there's some intention here, right? So it could get a little murky. But for the most part, right, that will does not take effect until after something happens to me, okay? Does it go to court, right? Well, wills have to follow the probate process. But like we talked about, let's not be like boogeymans about the probate process. In New Jersey, it's not so bad, okay? Not so bad in New Jersey. But again, other jurisdictions, a little more complicated. So yeah, if you're like Kim Kardashian, maybe you don't want to go through probate. Maybe then you want everything in trust simply because you don't want the entire world knowing that you're worth $1.5 billion and all of it is going to your like pet chihuahua. Okay. But for us regular folks, a will a lot of times doesn't even tell you that much, right? A lot of times it doesn't have specific dollar amounts. It'll be like, oh, like everything to Jen and my pet chihuahua. My house to my daughter-in-law, right? I mean, so it doesn't really like have balance sheets and that type of financial disclosure. But again, if you're Kim Kardashian, you still probably don't want everything, everyone knowing that business. Okay. The revocable trust avoids probate. Again, that could make sense in some of the situations that we talked about before. Irrevocable trust also avoids probate because it's not in your estate anymore, right? It is literally owned by that trust out of your estate. Okay. And is it public? We just talked about that. All right. 13 smart moves to protect your legacy. All right. So thank you, Jen. So here's 13 smart moves. And there's a lot here. Good thing we limited it to 13, Jen. All right. So let's go to the first one. Leveraging the annual gift tax exclusion and direct payment exception. So Jen, what do you like about this? These options here. What do you like about this?
I mean, the annual gift tax exclusion, I feel like actually could do a lot, especially if you're married and you continue doing that year over year. It's a really good strategy that adds up over time and also allows you to gift during your lifetime. I'm sure a lot of people want to gift when they're gone, but you like to see your kids or whoever, use that money while you're there. So I think that's really nice. And of course, the 529 super funding, we've had some clients do this and it, is beneficial to the client because you're getting a lot of money out of your estate, if you're high net worth and you are super funding these accounts early for the kids and they will only continue to grow. So I think those are two really, really great strategies, especially, if you have multiple grandkids, you could really be helping them out and getting them a lot of money out of your estate as well.
I love that, Jen. So it's $19,000 a year. A lot of people still think it's 15,000. That was like from, I don't know, like 10 years ago or something. And we once had a grandmother with like 7 grandkids or something. And so she was able to get close to like $150,000 out to the grandkids. Maybe it was close to 200. Then she was getting money out to her 4 children and then the 4 daughter-in-laws and son-in-laws. And so every year, it was probably close to $250,000 to $300,000 a year. Like that adds up. First of all, it's meaningful to the recipients because who's going to say no to 19,000 or 38,000 for a couple? So who's going to say no to that? So really, really a great feeling to be doing that for your loved ones and able to again get $200,000 to $300,000 a year out of the estate. Jen, if I give you this annual gifting, do I have to give some to Jay also, or does it all go to you?
That's up to you.
Okay.
Definitely to me though.
Okay. I love that. We love the 529 plans. They're just such a bonus opportunity in a lot of ways. Tons of flexibility in connection with 529, and OBBA expanded the opportunities in connection with 529s. A lot more flexibility. You can start using them in kindergarten now, all the way up through grade 12, college, graduate school, trade school, technical school, and then even CE credits for CPAs and other professions. So literally you can use 529s literally from the time you were 5 years old all the way to like your 70s or 80s. So lots of opportunities there with the 529 plans. Still one of my favorite things in the world. Good. All right. Next one. Paying medical and education expenses directly. And a lot of people forget about this, but if you help your loved ones, good. Lifetime gift exemption early. So like we talked about, you have $15 million federal, state depends on what state you're in. It is adjusted for inflation. So it goes up pretty measurably each year. Like I think last year, what was it? Was it 14.26 last year or something? It goes up a big chunk every year.
Yeah, I think wasn't it
Was it
13.9 or
Yeah, so it was what,
yeah.
13.94?
Yeah.
Was it 30? Yeah, right. So like that's a big chunk. It went from like 13.94 to $15 million, right? So like every year it's going up basically about $1 million, right? So that's really cool. All right. So if you are in what I call the splash zone, so if you are single and you're worth like 10, 12, 15 million, right? If you're in that splash zone and you're going to be gifting money anyway, right? Then maybe we gift so that we create some buffer between us and that $15 million. If you are a couple, then you have 30 million. Again, if we're worth like 20, 25, 27 million, maybe we start gifting, create that buffer, and get those assets out of the state and get the appreciation out of the estate. So remember, it's not just gifting the thing out of the estate, it's gifting all the growth that might create. What are we nervous about? Well, we're nervous that there's a change in administration down the road. And, some folks don't love this $15 million lifetime exclusion. Even more importantly, even if they let the 15 million stay, there are some amazing estate planning strategies that we're able to use that they would go after. So they'd say, oh, we're going to keep that 15 million because we don't want to upset the family farmer, because they make a big deal about the family farm. I mean, that's all I hear about is anytime they want to mess around with the lifetime exclusion, they're like, what about the family farm? Okay. And so then, okay, so, oh, we can't touch the family farm, right? So what they'll do then is they'll start limiting some of the trusts that you can use. They'll start limiting the discount you could use with a family limited partnership. And those are all the strategies that we would use first. So don't be complacent about this. I mean, if you're a couple and you're at 20 or 25 million, you're probably not going to spend that 20 or 25 million dollars. You're probably going to start gifting this. So let's, bring in some flexible trusts that let us have our cake and eat it too, is what I say. And let's do some of this planning. Let's create some buffer, and let's get into some of these strategies that may go away if another party gets in power and they want to sort of, tighten their grip on things. Okay. So, I'm a big believer in doing this lifetime planning, in appropriate situations. In connection with this, titling and beneficiary designations. Now, this is huge, and it's not the headline, okay? So we don't get to see this a lot because it's not splashy, it's not sexy, but it creates great opportunities for us. And so what we want to do is think about, at death, we get a step up in basis on these taxable accounts, right? And so what we want to do is make sure that we're transferring those lower basis accounts to somebody who's older or is sick, right? If there's a big age gap, we want to transfer those low basis stocks, low basis property into that person's name so that when they pass, the survivor gets the step up in basis, right? I know it sounds a little macabre, but this is how tax planning works, right? Now, again, with every strategy, there are risks and we need to be cognizant of it. If the person who is older, big age gap, or is sick, if that person is incapacitated, might make bad decisions, has a gambling issue, right? Well, then maybe you don't want to be transferring assets into their name. So again, with all these strategies, we need to be intentional. We need to be aware of the risks, and we're happy to work through that with you. But this is a great opportunity because when you die, right, then that you lose that step up. You lose that step up in basis. And so, I mean, we'll lose a step up in basis, right? It's like if you die and there are, let's say, losses in the account, then those losses, those things get lost, basically. And so we want to make sure that the low basis stock goes to like that older spouse. And then if you have losses in an account, you want that to stay with the younger, healthier spouse because the losses go away when you pass. So this whole notion of having joint accounts is not so effective from an estate planning standpoint if you're looking at it from a tax perspective. So these joint accounts, those TODs, right, they are convenient. Okay, they're convenient, but from a tax planning perspective, not so great. So if we have potential tax planning that we want to do around the estate, then those joint accounts, those TODs, not as effective. If we're not as worried about tax planning, because we don't have low basis stock, we don't have losses, right? Then, then maybe those TOD accounts, those joint accounts, they could be okay. And so we have a tendency to look at that to try to make recommendations, but by all means, feel free to share with us your thoughts, your personal situation, whether that makes sense to be shifting some of those assets around. And you need a 1-year runway, right? So you cannot do it literally at the deathbed. You need 1 year, okay? We also always need contingent IRA beneficiaries. Very important, again, with the tax planning, particularly with IRAs. We want contingent beneficiaries so that the primary beneficiary can disclaim and we skip over the primary beneficiary and go to the next generation or the contingent beneficiary if we so choose. And we can do that partially on assets. We don't need to do it on the entire asset. And so it's good to have a tool in your tool chest, right? Good. Let's rethink IRA beneficiaries. And so again, leaving a large IRA to a non-spouse is one of the worst assets you can leave to a non-spouse. So let me make that clear again. These large IRAs are kryptonite and one of the worst assets that you can leave to a non-spouse, i.e. your children. So if you have that large IRA, let's convert it to a Roth. Let's start taking distributions out of it, right? Like let's start modeling this out because particularly if it's a large IRA, they're going to pay a ton of taxes on it. And you're going to pay a lot of taxes in RMDs and also that widow's penalty if you're joint now and then you're going single. So a lot of minefields in connection with that large IRA. We have talks with almost all of you about this. We send out tons of announcements on this. We're constantly communicating about this. But if you have any questions, you want to talk with us, please feel free to reach out to Jen or the office. We're happy to have that conversation. Along these lines, right, is the sneaking in the Roth conversion. And we have done this with great results over the last several years when the market has pulled back, like last year in April, because of all that tariff talk, market was down 20% for like a month. We're able to sneak in a lot of Roth conversions in situations like that. We have a tendency to convert the technology stocks when we can, and those have gone up so much in value that I know many of you are now huge fans of the Roth conversions because you see that benefit in your accounts. And so bottom line is if you leave a traditional IRA to your heirs, again, non-spouse heirs, and there's, a few other exceptions, but basically non-spouse heirs, they have 10 years, they got to pull that account to zero, which is going to push them likely into a higher tax bracket. We don't want to do that to people we care about. We don't want to leave them a mess. So let's do this on our own. Let's prepay those inheritance taxes, essentially. Let's leave them an inherited Roth IRA. Or let's pull out some of those IRA assets. Let's spend them now if we're in a low tax bracket. A lot of ways that we can think through this. But the absolute worst thing to do is to leave a traditional IRA to non-spouses in most instances. Okay? Good. All right. Roth conversion strategy and timing. So yes, you do have to pay taxes on this, which is why we like it when the market goes down, because then they're on sale. Also, we'll sometimes spread them throughout the year. We'll wait until maybe you retire, if you're a couple of years from retirement and your tax bracket goes down. We'll also try to do these Roth conversions before RMDs kick in and before Social Security kicks in. And so a lot of ways that we can try to approach this. Yes, the market is breaking records. I know the last couple of days have been rocky, but basically the market's breaking records. At times it doesn't feel like, oh, this is a great time to do a Roth conversion. I get that, okay? Like I said, we've done a great job over the last 5 years of timing these. Maybe a little more challenging, but who knows, right? When the market pulls back, we might pounce again. But let's have high level the idea that directionally, if we have a large traditional IRA, a Roth IRA is typically going to make a lot of sense for us. The next slide is, just a little bit. The next slide is just a little mini case study, really explaining the benefits of the Roth IRA. And you see here where, like your traditional IRA balance, has gone down. You see your Roth IRA balance has gone up tremendously to $20 million. Thank you, Jen. The total portfolio value is even higher by almost $3 million. And your lifetime tax bill actually has decreased by $3.5 million. And so in this little case study, doing these Roth conversions, which was $300,000 by each person, so $600 for a married couple, for several years, really had, a substantial impact for this family. Jen, how many years did we do these Roth conversions for? 600,000.
I think this was to age 73, so from 67 to 73, so like 6-ish years.
Yeah. And look at that, millions of dollars in savings and leaving an amazing asset to that next generation, right?
Mm-hmm.
$20 million in Roth IRAs to the next generation, which means the income taxes are already paid. That also means then that they could wait until the last day of the 10th year, which means that 20 million would likely grow to about 40 million. And then they could take it all out, in that last day or that last year and not pay any income taxes on it, right? Like that is an amazing legacy. Good. Along these lines, let's leave great assets to heirs and let's not leave crappy assets to heirs. So what are great assets? Jen, what's your favorite asset on this list?
I like the Roth.
Yeah.
I want everything tax-free.
I love that, Jen. I love that. I think that's great. Well said. Well said. Roth IRAs, tax-free. So that's, that's HSAs, leaving them to a spouse. If you leave them to someone other than this spouse, they lose the tax-free status, actually. Cash is a great asset to leave to heirs. And even a brokerage account is pretty good because it gets that step up in basis, right? So these are some great assets to leave to heirs. The next slide is about inheriting the Roth IRA versus the traditional IRA. And I know it doesn't necessarily work like this in practice because I'm saying, okay, let's say we leave 2.1 million traditional IRA to non-spouse heirs, basically the kids. Let's say we leave 2.1 in a Roth IRA to the kids. What does it look like over that 10-year period? And what you see then is that Roth IRA basically can double over that 10-year period, and that 2 million basically becomes 4 million available to pull out, again, that last year, that last day, income tax free. So that's, that is really valuable, that growth that your children or whoever would be able to enjoy during that 10-year period and not have to worry about an income tax bill. All right, worst assets to leave to heirs. So we can't talk about best assets if we don't talk about worst assets. So Jen, what do you think are the worst assets to leave to heirs?
Well, of course, since I love Roths, I'm going to say I hate traditional IRAs, but
I love that. Yeah, that's a great answer. It's like kryptonite, those traditional IRAs. Also the annuities, right? Annuities are horrible to leave to the heirs in most instances, right? We mentioned the HSAs to non-spouse heirs. We need to make sure that we spend down that HSA if we are the surviving spouse. But all these other assets here, right? Illiquid or complex investments, even like real estate or any type of like operating business, collectibles. We also had guns on here, crypto, right? There's a lot of these assets that people have in their accounts or on their balance sheet that you might want to think about winding down before your heirs are stuck with them, right? And you're probably in a better position to sell these assets than your heirs. Just something to think about. Let's plan for Medicaid and special needs. So, a lot of laws and protections here, even within even the Trump accounts that were just, new legislation, special need trusts, also allows for a lot more flexibility and drawing down that inherited traditional IRA. So let's be smart. Let's go to a special lawyer about this, and let's make sure that we care about our loved ones and set up the proper mechanism. Assets with revocable trust. And so we talked about this a little bit. The revocable trust is still part of your estate because you can change your mind, right? So the whole point of getting something out of your estate means you can't change your mind anymore. You can't pull it back, right? The trustee is now in charge. If you have a revocable trust, that means you're still in charge. You can change your mind, which means it's part of your estate, which means you don't get the tax break, right? Like that's sort of the logic on this. But there are some practical reasons why we like the revocable living trust. We talked about that. And so these can make sense in certain instances. And the next slide talks to you about some of the benefits and some of the challenges, right? It does create complexity. There is no creditor protection. You do have to pay a lawyer to set it up. You've got to properly title your assets. You can't forget that. And there's no income tax benefits. So a lot of people, again, think that, revocable trust is going to answer all these things. And some of it doesn't, right? Some of it doesn't. So we've got to be clear on that. Consider advanced planning for taxable estates. So if your estate, like we talked about, 15 million single, 30 million joint, then we got to really roll up our sleeves, dig in. And yes, we will need irrevocable trust most likely. And yes, we probably will be doing some of this aggressive gifting. And so let's be sensitive to the size of our estate and let's do the right thing by our family, by our communities, the causes we care about. You worked your entire lives. You don't want this money going to Uncle Sam. Key benefits of advanced planning. So we want to reduce federal, estate, and gift taxes along with state taxes. We had a new client come to us, and she was in a very committed 25-year relationship, but they never got that little certificate from the town hall. And so she ended up paying inheritance taxes of almost $2 million in the state of New Jersey, just because they didn't get a piece of paper. Okay. That's very expensive to have to pay $2 million if you didn't get a piece of paper. Let's be smart about this. And by the way, the partner was an attorney in the state of New Jersey and somehow never took care of this. Okay. So let's be smart. Come talk to us if you got questions. Advanced planning strategies to consider. Again, alphabet soup, tons of acronyms. Depending on your situation, one or several of these may make sense. You need to have, good experts. The estate planning attorneys have become very transactional. So you need to be careful because if you show up to an estate planning attorney, they're going to do all of these for you. Okay. They're going to throw the kitchen sink at you potentially. So talk with us a little bit, run the executive memo by us, and we'll give you some feedback on this. The spousal lifetime access trust, the SLAT, is really one of my favorite strategies. This would be one of our go-tos as a starting point. Allows you a lot of flexibility to get these assets out of your estate, get the appreciation out of your estate, but you're still able to spend some of these assets. And they talk about this on the next slide, some of the benefits and the challenges. And so, yes, it's irrevocable, but it's a nice balance and it provides great flexibility. So something to think about if you're in that splash zone, right? Bypass trust for blended families. These used to be a lot more popular when the lifetime exemption was lower. We don't see these as much now, again, except in blended families or if the first spouse doesn't trust the surviving partner because he or she is unsophisticated or a big spender. It's usually some type of trust issue. Okay, good. Number 10, let's clean up investment clutter. Okay, so let's get our house in order and not leave a mess to the people that we love. So let's get rid of the complex assets. Let's make a digital estate binder. Let's make sure people know where our passwords are, all of that. Number 11, maybe we hire a professional trustee. Now, sometimes there are people that you can trust to take on this job, then fine, we will support that. But if you're like, hey, I don't really have anybody or things are super complicated, then, we do have the ability to pull in a professional trustee. Number 12, the deathbed planning and basis reviews. And so we talked about this, retitling the assets, gifting appreciated assets to the ill spouse, so we can cover that step up in basis at death. Also, we can gift assets up a generation or down a generation. And so if your kids are in a lower tax bracket than you, maybe we consider gifting assets down, but beware of the kiddie tax, okay? We can also gift assets up to our parents, but then when they die, make sure those assets are coming back to you and not to your brother, who's, troublesome. Is there something, Jessica? Oh, okay, Jessica's gone. All right, let's write a legacy letter. So if this is not, a will, okay? Wills are legal documents, and they're a little bit of a bummer, right? Even if you're the one that's inheriting everything, I mean, it's a little bit of a bummer, and it's drafted by attorneys. Maybe we write a legacy letter. We've had seminars on this. It's very powerful, and you're basically saying, hey, family, I love you guys. Jen is getting access to my bank accounts because I love Jen, and this is going to be helpful to her and her family. Caroline is getting my dog and my cat because she really loves my dog and my cat, and I think that's going to be great for her. And I already gave Caroline a bunch of stuff in her life, so that's why I'm giving Jen this stuff at death, right? And so it gives you an opportunity to reinforce your love for Jen and Caroline, and why you did what you did, so that people can understand that it was done in love. And maybe I will have to give Caroline some of the bank accounts, because I don't know if she'd get over the fact that Jen got all the bank accounts. So you want to be thoughtful about that. But the legacy letter is really great. We had webinars on this, and this next slide shows you the different sections of the legacy letter. And it's apologizing for times where you might not have been a perfect parent. It's telling your family that you love them, you're proud of them, you believe in them, sharing memories, right? It's really, really moving. So yeah, we've done a lot of work in this area, and if you want some guidance, reach out to Jen or myself, and we'll share with you what we've put together on this. All right, we're running out of time here, Jen. Hopefully everybody is stuck with us, and this has been helpful to them. Let's keep going, Jen. We're going to power through. So key OBBA, just some things to think about. We only have like 2 or 3 more slides, and you guys have been great. So our 15 million / 30 million federal estate exemption here. GST, generation skipping, also matches, right? For those of you who do have those bigger numbers, right? 37% tax rate for those trusts. So when you go see an attorney, you're like, yeah, just put it into a trust. You're like, not so fast. We need to talk to Debbie and Jen about this. Remember the charitable deduction floor, courtesy of OBBA, 0.5% minimum of AGI for clients who itemize. So there is now a floor. You're not going to get dollar for dollar for every charitable contribution you make if you're itemizing, okay? So let's be thoughtful, about this, right? Strategic window of opportunity. So like we were talking about before, with these large lifetime exclusions, very low income tax rates, let's not blow it. Let's not take it for granted. Let's not think it's going to be here forever. Even though technically they labeled it permanent, permanent in Washington is like a Hollywood marriage. It literally can last 90 days or 6 months or whatever. And so let's take this time to lock in the flexibility, lock in the clarity for multi-generation wealth transfer. This next slide is great building blocks for you. So it really summarizes the entire deck and breaks out, hey, Debbie, I'm in that $0 to $15 million range. Great. Here's a little checklist, right? Those foundational documents, some of the titling, right? Here I'm, my partner and I are $15 to $30 million. Well, now we got to start, adding some more considerations on. And hey, we're $30 million plus. Good for you. We now need to start pulling in some of these irrevocable trusts, do all this planning, think about multi-generational gifting and things like that. So just sort of a little bit of a cheat sheet, and then bring it all together. 5 things. Estate plans must be created and maintained. So if you created it 10 years ago, or even if you created it 4 years ago, but Aunt Trudy has since passed and she's your executrix, hey, we got to get in there. We got to update it, right? We changed addresses, family situation changed. Number 2, documents and designations drive outcomes. So let's be smart. Let's make sure we have beneficiary designations. That overrides your will. Okay, your beneficiary designation on your life insurance policy, that wins. That wins. That beats your will. So let's be smart about that. Not all assets transfer well. And so we talked about that, right? Good assets to pass on and bad assets to pass on. So let's clean things up, right? Let's make it easier for our loved ones. Taxes shape legacy results, right? So if we want to preserve and grow our wealth and leave it to the next generation, let's think ahead. And that 10-year inherited IRA rule is horrible. So let's do our Roth conversion planning. Let's do our advanced trust planning. Let's not leave garbage to the people that we care about, particularly a traditional IRA. And let's communicate, right? Our fiduciaries, document our wishes. And that legacy letter can be a great tool. And so with that, then, we are done in 50 minutes. We're happy to take questions. I think we have to go off recording. So Jen, I will hand it back to you and we'll take